Good morning. It's July 13th. I'm Arthur Hur. You're watching live futures trading with Hur Fund. That's me. And right now, Hur Fund not doing so well. This is the second time I'm recording this because I realized I was playing like a playlist that I used to nap my kid, and it was polluting the feed, the audio feed. So I'm recording this again. But bottom line is, we're not doing so hot. The only thing that's happened right now, since it's day 5, the only thing that's happened after we put our trade on was everything has just been going higher. Crude oil has just been going up and up, and the dollar has been going down and down and down. It's been a pretty intense move. Let's just briefly talk about why I choose straddles over strangles. Someone posted a very thoughtful comment and question on the feed yesterday, so I wanted to address it directly instead of talking about what I was going to talk about, which I'll probably talk about tomorrow or maybe next week. But the reason why, from just a very high level, is the fact that when you're selling options, you are taking on a very an inordinate amount of risk. And if you're going to take that amount of risk, whether it's volatility risk, price risk, and the amount of losses that you can incur are unlimited, right? So you will completely drain your account if things go wrong. So I mean, it's not something to take lightly. If you were just buying a stock and the thing went down 50%, you lose half your money. That's horrible. But if you were buying calls and it went down 50%, you lose everything. If you were selling, if you were doing a strategy that you didn't really know what you were getting yourself into, and you scaled it up, then there's huge potential for things to go wrong. And so if you want to take on that amount of risk, you need to make sure that you are going to be properly compensated. So that ratio between risk and reward needs to be just right. And I would argue that you should maximize the amount of reward, because you'll be collecting a percentage of that. And the more you're collecting in the beginning, the more you'll be able to collect of that over time. Now, I'm doing this in real time, and the only thing that's happened after I put on this trade is that it's lost money. So I hope it's entertaining watching me suffer, but it is what it is. And hopefully you're doing something else and you're just either you don't have anything at risk, or you're doing the opposite, in which case I applaud you. But yeah, that's my life. I don't know why I chose to do this. I don't know. See what happens. Let me share my screen. We are down 380 on this trade. It's not horrible. It is horrible. But it could be worse. So it's down a lot worse than when I was first recording this. So let's just timestamp this: 29/6/39/07. So we're almost down 1.5% on our account. We will adjust when this gets to 78.50, and I'll show you how that works and the thinking behind it. But the idea behind when you're doing that strangle versus when you're doing a straddle is, in a certain sense, it seems less risky to do the strangle. And it might seem like you're putting that range on because you don't know what's going to happen. And in a certain sense, that's true, right? That's why you're putting that range on. But what you are assuming is you're assuming that it's going to stay in that range. And you're betting that it's going to stay in that range. When you put a straddle on, you're saying, I don't know if it's going to go up or down, but I'm gonna put my bet here, place my chips here, and based on what that move is, then I will set the range. So the range is a little bit smaller when you start with straddle, but when it definitively gets to your point, then you can say, okay, well, that's the range. And so when you're going from a strangle to a straddle, your window of opportunity is diminished. All right, so whatever it is, here's the price, right? Here are your two strikes. It goes down here, right? You've been rolling down this call. Now this is the only place where you can make money. It goes down further, I guess you lose less, right? But what if it goes back in your direction? Now you've pretty much chopped your knees, and so you're kind of screwed if it goes back in the direction that you wanted it to. So when you roll down that call all the way down to the put, you end up with a strangle. You not only are you locking in losses, but you're cutting off your opportunity to make things back. So I mean, that's just the high level explanation of why I do things kind of backwards. And obviously it's not working right now. So I don't know. At the very least, I'm putting this out there. It's my decision. I don't know how much longer I'm going to be doing this. So if you get anything out of this, even if you just enjoy watching me suffer and there's like a little bit of satisfaction out of it, or schadenfreude, or whatever you want to call it, let me know. You can like the video. I'd appreciate it if you subscribed. And more importantly, just comment below, or send me an email. We'll see what happens. Over $400 in losses sucks, but it could be worse. I don't know. Thanks for sticking with me. All right, I'm going to sign off now.